First of all, good morning. I hope everybody's enjoying the presentations thus far, and I don't put anybody to sleep over the next 25 minutes or so. In looking at the list of attendees, I saw quite a few familiar names, but for those of you that don't know me, my name is Ben Ziccardy, and I'm a manager based in Brown Edwards Roanoke office. I've been with the firm almost 6 years and spend roughly 75% of my time in the weeds of the government accounting and auditing world. For the remaining 25%, my goal is to spend about half of that on vacation. I still haven't figured out whether that's because I miss the government work so much or if it's the necessary recovery time from our busy seasons that stretch basically from August through the end of November and into December these days. I'm very excited to be here today, and I'm going to touch on two new standards that it would be entirely possible to overlook, given what I'm sure most of you are dealing with in implementing GASB 87. Thankfully, both GASB 94 and 96 are very similar in substance to the aforementioned 87. Jumping right into GASB 94, which covers public-private and public-public partnerships as well as availability payment arrangements, we'll start with the who, what, and why this is important. The who, of course, is GASB. The what is they're looking to define several terms and their treatment. Beginning with public-private or public-public partnership arrangements, referred to as PPPs, they are defined as an arrangement in which the government or transferor contracts with an operator, which can be governmental or non-governmental, to provide public services by conveying control of the right to operate or use a non-financial asset. This asset is considered to be the underlying PPP asset, and it could be infrastructure or other capital assets, such as one used for public transit for a period in an exchange or exchange-like transaction. The second term is a service concession arrangement, or SCA. This is a type of PPP that meets the following three conditions. The operator is compensated by third-party fees. The transferor determines and/or has the ability to approve or modify the services, which services must be provided and to whom they are provided to. And the transferor is entitled to significant residual interest in the service utility at the end of the arrangement. Finally, APAs, or availability payment arrangements, are a situation in which the government compensates an operator for services that may include designing, constructing, financing, maintaining, or operating an underlying non-financial asset for a period of time, again, in an exchange or exchange-like transaction. The why is pretty straightforward. Kind of seems this is always the case, but it's to improve financial reporting, which is accomplished by establishing definitions for PPPs and APAs, as well as prescribing uniform treatment for the underlying transactions. So the current treatment is not very widespread. Currently, only SCAs are defined, and they are treated similarly under GASB 60 as they will be under GASB 94 when it's implemented. 94 will supersede GASB 60 and widen its applicability by defining the three terms we just discussed, non-SCA PPPs and APAs, as well as continuing to recognize SCAs. It will also extend its reach to all three of these arrangements. Of course, something like this comes with new accounting implications. Under this new standard, there are three basic scenarios to consider when recording the transactions. There are countless variations possible. However, these three are sort of your basic starting point. The first is when the underlying asset is an existing asset. This is whether the arrangement meets the definition of an SCA or not. And at commencement of the PPP, the transferor will record a receivable and deferred inflow, both of which are equal to the present value of the installment payments. Additionally, they will continue to recognize the underlying asset as it is currently recorded on the books. If improvements to the underlying asset occur during the PPP term, the entity will also recognize an addition to the asset in deferred inflow when the improvement is placed into service. The operator in this case will record a liability for installment payments and an intangible right to use asset. The second scenario to take a look at is if the underlying asset is either newly constructed or newly purchased and the PPP meets the definition of a SCA. In this case, the transferor recognizes a receivable and deferred inflow for any term, and they will recognize an asset and deferred underlying PPP asset is placed into service. In this scenario, the operator will record a liability for installment payments and record a right to use asset. Lastly, if the newly constructed or purchased asset does not meet the definition of a SCA, the transferor at commencement records nothing. When the asset is placed into service, they will record a receivable for the underlying PPP asset, a receivable for any related installment payments, and a deferred inflow, which is equal to the sum of the two receivables. On the other side, the operator at commencement will recognize the asset until it is transferred to the transferor, applying other accounting financial reporting requirements, including depreciation, impairment, et cetera, Then, when the asset is placed into service, the operator records a liability for the asset to be transferred, a liability for any installment payments, and a deferred outflow for the asset to be transferred. Obviously, with the new standard comes new disclosure requirements. This slide lists them based on which side of the arrangement you're on. So for the transferor, the note disclosure should include a description of the arrangement, the nature of the assets and deferred inflows that are recognized in the statements, the discount rates that are used when measuring receivables from installment payments, the amount of inflows recognized in the reporting period for variable or other payments that are not included in the receivable as applicable, and the nature and extent of the rights retained by the transferor or granted to the operator under the terms of the PPP. On the other side, the operator will also include a description of the arrangement. For them, they include the nature and amounts of assets, liabilities, and deferred outflows related to the PPP, discount rates that are used when measuring liabilities from installment payments, P&I requirements for the following 5 years and in 5-year increments after that. This is going to mirror your current debt disclosures that are reported each year. Also, the amount of outflows recognized in the reporting period for variable and other payments that are not included in the liability, the nature and extent of the rights retained by the transferor or granted to the operator, similar to the transferor disclosure requirement, and the components of any loss related to impairment or other related change in the liability. I wanted to provide a quick example of what this new disclosure will look like. The following assumptions and facts were actually pulled from the standard that was written by GASB, and you'll see them all on your screens now. In this situation, the state, through their State Department of Transportation, is the transferor. They enter into an agreement with the County Bridge Authority, who will be the operator. to design, build, and operate a bridge for 30 years by collecting and retaining toll revenue. In this situation, in exchange for the transfer of ownership at the end of the 30-year term, the state conveys the right to operate, set, collect, and retain toll revenue. When the agreement is entered into, the bridge is 30% completed and will be done and placed into service at the end of the following year. Because the CBA can set prices and is not a component unit, it is not considered an SCA. The facts here are the cost, which is $1.2 billion, a useful life of 40 years, and a carrying value at the end of the arrangement of $300 million, and you can see the calculation there. So looking at the disclosure requirements, first for the transferor, or the state DOT, during the year in which the agreement is entered into, you can see that their disclosure has all the required elements. It has a description of the arrangement, it identifies the parties, and also the term of the CBA with the rights that are conveyed to the CBA based on the agreement. To the right, you'll see the requirements once the bridge is placed in service. And again, the elements are all there. The description of the arrangement. You will see the value or the amount at the bottom, the 300 million, identified as the receivable and the deferred inflow, as well as the rights conveyed to the CBA and the term of 30 years. On the other side of that are the CBA disclosures, which are very similar. As when we looked at the listing of the required elements, there's a lot of overlap between the two. So at commencement, again, you'll see all the required elements, the description, the term, the asset that's being recognized as CIP, or construction in progress, and the residual value at the close of, or when it's placed into service and at the close of the agreement. And on the right is the disclosure once the asset is placed into service. Again, with all the required elements there. Now, I'm sure a lot of you will be wondering how this will impact you all going forward. Looking ahead to implementation, the biggest impact in some cases will likely be the additional work required to evaluate these contracts and agreements. However, it certainly could result in the recognition of new items in the financial statements to include new deferred inflows, outflows, assets, and liabilities. Preparation for implementation can be done somewhat concurrently with GASB 87. Agreements that don't fit the definition of a lease should be set aside and evaluated with the requirements of GASB 94. Additionally, if you have agreements that currently meet the criteria for GASB 60 and are classified as SCAs, they should be revisited to ensure that they still meet those definitions. As far as obtaining help outside your organization, it certainly isn't required, but I think the short answer is it's up to you. Because this can be done somewhat concurrently with GASB 87, you could certainly use that same specialist in the evaluation of these agreements. From an audit perspective, we are largely going to be relying on information provided by you all, by our clients, as we evaluate those agreements to determine whether or not they fit the criteria for GASB 94. Beyond that, the annual disclosures that are currently in your notes that detail intergovernmental and other agreements is another place that could serve as sort of a completeness check for us as we're evaluating 94's applicability to what you all currently have in place. Finally, I'm sure a burning question for most of you is there going to be a required restatement to beginning net position or fund balance? And the answer is that while it's not required to restate to the beginning of each PPP term, the provisions should be applied retroactively by restating all presented prior periods, if practicable, and reasonable efforts should be made. GASB does explicitly state that inconvenience is not considered equivalent to not practicable. This standard is going to be applicable for fiscal years beginning on or after June 15th, 2022. So for most, if not all of you, that will be FY23, and earlier application is always encouraged. There is the caveat that the terms in this standard need not be applied to immaterial items, which of course is up to professional judgment. So I think at this point, as everybody lets that sink in, we'll launch an attendance question before we move on to GASB 96.
Launching the attendance poll. Closing the poll.
So jumping into GASB 96, this is one that should sound very familiar to those of you lucky enough to be well versed and in the weeds of GASB 87. It is very similar. The who, again, is the usual suspect, is GASB. The what is this standard defines subscription-based technology arrangements, or SBITAs, including items like cloud-based data storage and remote access, as well as providing uniform guidance for the accounting treatment of the arrangements that meet the following definition. An SBITA is defined is for temporary use, but a period greater than 12 months, which should sound familiar. It grants control to use the vendor's IT assets, either used alone or with a tangible capital asset, which is referred to as the underlying IT asset, and as an exchange or exchange-like transaction. These SBITAs do closely resemble a lease, and the standard is going to mirror 87 in many respects. The why? Currently, there's no uniform guidance for the treatment of these arrangements, and they differ from many traditional setups because access is temporary. Also, GASB 87 explicitly excludes the lease of intangible assets. I think the first question to answer is how this item is currently treated, and the answer is it's inconsistent. There is no authoritative guidance from GASB currently that has the scope that 96 will provide. The most common treatment has been based on FASB standards, which results in either a licensing agreement arrangement or a service contract, the latter of which requires the capitalization of certain implementation costs, and neither of these is entirely accurate, and the inconsistency in how this has been handled has resulted in an increase in the number of technical inquiries received by the GASB, which is probably a large part of the why. This clearly will have accounting implications, and they are broken down into two general categories: subscription costs and non-subscription costs, both of which have 3 stages. For subscription costs, the first is going to be prior to commencement. During this phase, the entity should record a prepaid asset that is equal to the amount of any initial payments and capitalized implementation costs. That prepaid asset will be reclassed then to the subscription asset at initial measurement, which is referred to as the commencement of the term. Second stage is the commencement of the term, which is defined as the time the subscription is actually able to be used. At this point, the entity should record an intangible right-to-use asset that is equal to the liability, any initial payments made, and capitalized implementation costs, which we discussed as part of the prepaid asset. The other side of that entry is going to be to recognize a subscription liability, which is measured at the present value of payments expected to be made during the term. Those payments could include anything that's fixed or variable, payments for penalties. If there's contract incentives, those would be included, and any other payments that are quote unquote reasonably certain to be made to the SBITA vendor during the agreement. Finally, we have subsequent reporting. At this stage, the subscription asset should be amortized beginning at the commencement of the term over the shorter of the SBITA term, or if it's used in conjunction with an underlying IT asset, the useful life of that asset, with the debit being posted to amortization expense. This may be combined with depreciation for reporting purposes. And the subscription liability during the subsequent reporting should be reduced by subscription payments that are made less the portion of payments that is related to interest expense. So the second category of costs are those other than subscription payments. And they are kind of broken down into a similar set of 3 stages. During the preliminary project stage, which is made up of conceptual planning, the evaluation of alternatives, and then the final selection of the software that's to be used, any outlays that are made prior to the completion of all 3 should be expensed as incurred. After that stage is completed, you move into the initial implementation stage. Outlays during this phase should be capitalized as part of the subscription asset, unless, of course, it is a short-term SBITA, which is less than 1 year. At that point, they should be expensed as incurred. Finally, the arrangement enters the operation and additional implementation stage. During this phase, all operational outlays should be expensed as incurred. Outlays that are associated with additional implementation that either increase the functionality, which is defined as something that allows the entity to complete tasks it could not before, or the efficiency, which is a change that increases the level of service without adding additional capabilities. Both of these should be capitalized as an addition to the subscription asset, with outlays that do not contribute to either being expensed as incurred. So now that we have the accounting down, let's look at the disclosures. So the new disclosure requirements should look familiar, and they're listed on this slide. They'll include a general description of the SBITAs, which may be grouped, and should also include the basis terms and any variable payment conditions, the total amount of subscription assets and related accumulated amortization, the amount of outflows for variable and other payments that has not previously been reported in the subscription liability. Again, P&I payment requirements to maturity separately for the subsequent 5 years and 5-year increments after that, which is similar to your debt disclosures. And then commitments prior to commencement and components of loss associated with impairment as applicable. The disclosures above were developed to mirror those in 87, so as to reduce some of the effort and cost involved in implementation. So they should take the same basic form. I think the biggest impact is that it, again, could result in a recognition of additional assets and liabilities very similar to GASB 87. with my recommendation for preparation being to use the same approach that you all are employing for 87. You'll need to evaluate subscription-based IT services to determine several things, including do they meet the definition of an SBITA? Are they material? And are they short-term? Again, this can be done concurrently with 87 as it's very similar. With outside help not being a necessity, but certainly an option, especially if you're already using an outside consultant for GASB 87 preparation. As auditors, we're certainly going to be looking at agreements with IT companies that we already have. Items may pop up during variance analysis that we complete. If we see material expenses or expenditures paid to known tech companies. As well as our review agreements. So I can imagine one question you may have after hearing the specifics of GASB 96 is why is there a separate standard from GASB 87 as they are so similar? I think the true answer is they just needed a space filler for that specific number, 96. In all seriousness though, by writing a separate standard, the board was able to eliminate any ambiguity that's associated with the term IT hardware, which you'll see throughout some standards. And while it's widely understood on a practical basis, the term lacks an accounting definition. GASB 96 is written specifically to exclude tangible capital assets and provide a strict definition of an SBITA. It also excludes standalone tangible capital assets, whether they are by themselves or they come with a pre-installed software component such as an operating system. Finally, will there be a required restatement to beginning net position or fund balance? The statement should be applied retroactively by restating all prior fiscal years presented. If restatement is not practicable, the cumulative effect of applying the standard should be applied as a restatement of beginning net position for the earliest fiscal year presented. In the first fiscal year this is applied, the note should disclose the nature of the restatement, its effect, and the reason for not restating prior years that are presented if it's applicable. The same as 94, GASB 96 will be applicable for years beginning after June 15th, 2022, FY23 again, with the same caveat that it need not be applied to immaterial items. So in closing on 96, I did want to say thank you for listening. And as I turn it over to Danielle to touch on upcoming GASB projects, we'll launch another attendance question.
Launching the attendance poll. And Benjamin, we did have a question come in, so once I close that, I will read that off to you.
Okay.
Closing the poll. Okay, and the question is Brown Edwards seeing any clients use a threshold for GASB 87, 96, and 94 that varies from an entity's capital assets threshold?
Personally, I have not seen any differences in those, and in full transparency, I haven't spoken with clients about 94 or 96 in great detail yet, as everyone is pretty well wrapped up in 87, and I have not seen a variance in those two evaluation numbers.
All right, thanks, Ben. My name is Danielle Nikolaisen. I am a audit director here at Brown Edwards. Do a ton of work in the governmental space, and so I am going to be talking to you briefly about an upcoming GASB project. So, trying to advance the slide here. I think I got it though. There we go. Okay. So in addition to the actual issued standards that are upcoming that have been talked about already, the GASB is currently working on a few projects that are in various stages of development or issuance. They're working on a conceptual framework project, which is further broken down into two separate pieces related to disclosure and recognition. Those are both in the exposure draft stage right now also. Additionally, the GASB is working on a revenue and expense recognition project, and that project is meant to try to develop a more comprehensive principles-based model for the recognition of revenues and expenses. That project is currently still in the preliminary views stage. So they don't even have a draft of the standard out yet. So what I'm going to talk about today is the fourth project that is currently in the works, and that is the financial reporting model improvement project. So I get the slide to go. Okay, so the overall objective of this project is to make improvements to the financial reporting model. This includes re-examining Statement 34, which is the statement, and also the other reporting model related pronouncements. We have Statement number 35 related to public colleges and universities. We have 37, which is the omnibus, 41, which is budgetary comparison schedules, and some others. The objective of these improvements would be, one, to enhance the effectiveness of the model and providing information that's essential for decision making, but also to enhance the ability to assess the governmental's accounting and address certain application issues based on some research that's been done pre-agenda for all of this. Just a little bit of background. Statement 34 was sort of the big financial reporting model statement. And that was sort of the culmination of 15 years of research, deliberation, and due process. So in this statement, this is when the GASB established our present blueprint for state and local government financial reporting. So this includes the format, the measurement focus of the basic financial statements, including related notes, required supplementary information that includes the management's discussion and analysis, the MD&A. Among other things, Statement 34 introduced the government-wide financial statements that contained the accrual information for activities that had previously only ever been reported on the modified accrual basis. And so that included reporting of infrastructure and other capital assets, as well as long-term liabilities. Statement 34 also required that the narrative MD&A be added to precede the financial statements. It added the original budget requirement for the budgetary comparison schedules. It introduced the major fund reporting in your governmental and enterprise funds. And it also added the disclosure, the requirements for your note disclosures for capital asset and long-term debt. So those are those roll forward schedules. And this was all effective in and around FY, or I guess 2002, FY02 sounds right. As part of its commitment to maintaining the effectiveness of its standards, the GASB decided to re-examine the current financial reporting model now that it's been in place for a while. They conducted some pre-agenda research, and it showed that most of the components of the financial reporting model are effective, However, they did identify several areas for improvement. And so those are the areas that are being addressed in this current exposure draft of this proposed statement. And as you can see from this condensed timeline on the slide here, this project has been in the works for nearly 10 years already. Just a summary of what's included in this proposed statement. First of all, it gives a little more guidance as to the form, structure, and content of the MD&A. It would further provide guidance on the definition of unusual or infrequent items, and it also includes a requirement as to how these items are displayed or presented on the face of the financial statements, both the government-wide and the fund basis statements. So that's applicable to both governmental and proprietary fund statements. The third item here is sort of the biggie. So this statement would essentially change the measurement focus of the governmental funds financial statements. So currently we're under the current financial resources measurement focus, and it would change to a short-term financial resources measurement focus, and we'll talk about that later on. But essentially, currently we have, you know, sort of your set accrual period after year end that you can accrue through for your governmental funds, 30 days, 45 days, 60 days. And under this proposed guidance, that sort of goes away. And instead, it's really looking at the underlying transaction to determine whether or not it's short-term versus long-term, which then would decide the method of accounting for that transaction. The proposed statement would also change the titles and some line item captions or descriptions of the governmental fund financial statements. It's going to provide some additional guidance for proprietary funds in determining operating versus non-operatings. There's a lot of inconsistency there. I'm sure we've all experienced the decision of trying to figure out what's operating, what's not operating. And it's also going to require the breakout of non-capital subsidies from other non-operating activity, which we'll talk about later on in the slides here. And then finally, it addresses some other small items, changes some required content and note disclosures around budgetary comparison schedules. So, okay, got it. With regard to the MD&A, clarification and additional guidance. There's not a lot of huge changes here, but there is some clarifications and some further guidance here with regard to the structure of how the MD&A should be set up. So it further emphasizes the fact that the analysis should be fact-based and should discuss the activities that negatively or positively impacted the government's financials in terms of balances or results of operations. It does place an emphasis on the fact that there should be a discussion regarding these changes and not just the dollar amount or percentage by which they change. It's very clear in the proposed standard that just a simple dollar or percentage variance is insufficient. It also really highly encourages the use of charts, graphs, and tables because they're deemed to really enhance the understandability of the information that's included there. The proposed guidance does explicitly state that the MD&A should avoid unnecessary duplication. So certain explanations where they may be relevant to the discussion in multiple sections of the MD&A, it does say that those explanations should not be repeated after they have been presented initially. So for example, a tax rate increase enacted during the year may affect the results in both the government-wide and the governmental fund financial statements, but after that increase is discussed in the government-wide analysis, you can reference that discussion on your fund basis discussion, but not duplicate that whole thing altogether. Also, it lays out the structure of the MD&A into the following 5 topics. We've got the introduction, which is pretty self-explanatory. We've got a financial summary, which is going to be your condensed financial information derived from your government-wide financial statements, which is current year to prior year, and an analysis of that financial position and results of operations. And then we've got the detailed analysis. And so this is when it really goes into detail for your governmental activities, your business type activities, percentages or dollar amounts of significant changes, your major funds and your non-major funds in the aggregate should also be presented here. Moving on, the fourth item is going to be your significant capital asset and long-term debt activity. This is not a big change, with the exception of the proposed guidance does explicitly state that commitments for the acquisition of capital assets should be included here. And then in terms of long-term debt activity, it references leases, public-private and private-private partnerships, public-private partnerships and public-public partnerships, and then also the subscription-based information technology arrangement. So that's all that stuff that we've just talked about earlier in this webinar series, are all meant to be incorporated here in the MD&A. And then finally, we have the currently known facts, decisions, and conditions, and it's got some really good examples in the proposed standard as to what should be included here in terms of economic or demographic trends, customer base, income levels, building permits, enrollment, you know, all that good stuff. What I will note here is that budgetary analysis for budget to actual results is not mentioned here. And the reason for that is because you'll see later on, they're adding some additional analysis in another part of the required supplementary information. So the GASB's goal here is to really improve the quality of the analysis of the changes from prior year, which theoretically then is enhancing the relevance of that information to the users of the financials. And the exposure draft does include an example illustration for reference. With regard to unusual or infrequent items, so with this guidance, the GASB is hoping to provide some clarity with regard to which items should be reported here separately from normal inflows and outflows of resources. So unusual or infrequent items are transactions or other events that are unusual in nature and infrequent in occurrence. And the proposed statement does make reference to GASB 62, which includes the definition of these items. So that is going to remain in this updated model. The biggest difference here is that the proposed statement provides guidance as to where in the statements these items should be presented. And so they're always going to be included as their own separate little section at the bottom of the statement that it's in, whether it's your fund basis statement or your governmental fund statement or your proprietary fund statement. It's going to have its own separate section separated out at the bottom. And then it's also going to require a note disclosure for these items. And that note disclosure is going to need to include the program, function, or any other identifiable activity to which these items are related and whether or not that item was within the control of management. And so we've got a polling question here. Did you know the GASB was working on a financial reporting model improvement project?
Okay, launching the last poll. Closing the poll. So 61% yes and 39% no.
Cool. Well, good. We've got a lot of people here who aren't totally surprised and shocked, hopefully, by by what we're talking about right now. So moving on to the third component of this proposed statement, measurement, focus, and basis of accounting. So under the current guidance, we have, and this is just talking about your governmental fund financial statements. So right now we've got the current financial resources, measurement, focus, and the modified accrual basis of accounting. And so under this new proposed guidance, we are going to be reporting under the short-term financial resources measurement focus. So we're talking about moving from current to short-term, and for them the distinction is pretty important. And we'll talk about that later. But right now the guidance says accrual basis of accounting. In the minutes of one of the GASB meetings, when they're talking about the changes that are going to be made from this exposure draft to the final statement, they are considering keeping the word modified in to help further clarify. So that might not end up changing. So really the focus here is on the measurement focus. So just some terminology to help wrap our heads around what is this thing even talking about. So when we're talking about measurement focus, we're referring to what items should be reported as elements of the financial statements. And then when we're talking about the basis of accounting, we're talking about when those elements are recognized in those financial statements. So when we're talking about the short-term financial resources measurement focus, we're looking at all short-term financial assets, deferred outflows, liabilities, deferred inflows, and fund balance. And in the financial statements, we're talking about inflows and outflows of short-term financial resources. And so this is what was sort of going to be formally known as revenues and expenditures. It's all flow-based. So we're talking about inflows and outflows. And then under the modified accrual basis of accounting, we're talking about short-term transactions and other events being recognized as they occur, and then long-term transactions and other events being recognized when the payments are due. When making the distinction between short-term and long-term, it's based on the period of time that's going to elapse between the inception of the transaction and the conclusion of the transaction. And the GASB exposure draft, excuse me, goes into a lot further detail regarding what qualifies as a transaction, what counts as the inception, what counts as the conclusion. And I'm sure as the standard is finalized and gets closer to implementation, we'll have a webinar that's totally devoted to talking about this one, implementation, and how to determine these things. But just for the time being, big picture, the period of time from inception to conclusion. And short term is going to be anything where that period is 1 year or less, and is also going to include any inter-fund balances and activity. That's going to automatically be assumed to be short term. And then long term is just anything that's not short term. Excuse me. So for the purposes of short-term financial resources measurement focus, we're talking about assets are those that are arising from short-term transactions. So cash, easily convertible to cash, consumable in lieu of cash, investments, inventories, and prepaid items. And then, excuse me, liabilities, there's no big change there. Again, deferred outflows and inflows, there's no big changes here. The guidance around these it's pretty consistent with what we're operating under currently. Excuse me. Short-term transactions and events, as I mentioned, are going to be recognized as they occur, and long-term transactions are going to be recognized when payments are due. There are some exceptions related to, forgot to move the slide. Got in a hurry, I realized I'm low on time. So there is an exception related to long-term debt that's issued for short-term purposes. And so that's going to be your revenue and tax anticipation notes is an example that they give for those. And then also they're talking about when payments are due for long-term transactions. If that payment is going to be made in advance of the due date, then it's recognized as the payment is made or received. So if you're talking about a debt payment that's due in July that you make in June, you're not going to defer that. That's going to be recognized in the period in which that payment is made. And then in terms of the face of the financial statements under the current guidance, we have a balance sheet and a statement of revenues, expenditures, and changes in fund balance. Under the proposed guidance, we're going to have a short-term financial resources balance sheet and a statement of short-term financial resource flows. So again, everything is changing to reference short-term financial resources and then flows. The face of the governmental fund financial statements under the proposed guidance would be separated between current and non-current activities. Non-current activities would be limited to those related to capital assets, long-term debt, and then capital-related activities. That's your leases. Also, the term revenues and expenditures will no longer be applicable. So you'll see the term special revenue funds being replaced with the term special resources funds. And again, this is the face of the financial statements and the titles. We're going from revenues, expenditures, and other financing sources and uses to inflows of resources from current activities, outflows of resources from current activities, your net flows from non-current, and then your unusual and infrequent items. And I realize this is blurry. I couldn't get it any more clear, but this is just to show big picture, high level, what these statements are going to look like. At the top, you've got inflows of resources, and you've got your taxes. This is sort of the stuff that you're used to seeing up in your revenue section, with the exception of here, you've got transfers in. So that's being deemed to be a current activity. And then here you have your outflows of resources, again, very similar, general government, public safety, public works, but then you've got your transfers. And then you've got your separate section for net flows from non-current activities, and then your unusual or infrequent items. And I'm running low on time. I think I'm gonna have to skim through very quickly, but this information is in the slides that you'll have after the fact. But for the proprietary fund financial statements, it defines what they consider to be subsidies, and it defines what is going to be included as non-operating, and then anything that's not included in non-operating will be included in operating. So it specifically defines for you what operating versus non-operating is. And then again, we have an illustration here for what that statement is going to look like. We've got operating revenues, operating expenses, your non-capital subsidies, and then your other non-operating. So that's what that's going to look like there. Again, some changes to the budgetary comparison information. Big picture is there will be a variance column added for your original versus final. And then the notes to the RSI will include an analysis of any significant variances from these two columns. And this is just an example illustration here. And then there are some other small items which I'll sort of skip over now, just for the interest of time. What the proposed statement does not do, since there are some rumors flying around and some pre-agenda items that were considered to be thrown in here that are no longer being considered to be items within the proposed guidance. And the effective date, FY 25 or 26. So we've got a lot more time to talk about these things. And the anticipated issuance is going to be FY 23, or calendar year 23 is when we expect the final statement to be issued. Thank you for bearing with me through this discussion. And is Chris there? Am I turning it over to Chris for some final remarks?
Yes, and Danielle, I have a question too.
Oh, great.
And this is for anyone. It's a GASB 87 lease question. Do you or any of the presenters know a locality that implemented GASB 87 leases early?
I do not. But I'm gonna let Chris jump on, and he might know of somebody who did.
There was talk. Can you hear me?
Yeah.
One of our cities talked about it, but I think we cautiously said, "Are you sure?" Because and I don't think they ended up early implementing it. So none of our current clients that I'm aware of, because I'm pretty sure that if we had a client that early implemented that, they would have run that. I would have probably been involved some way or another. Oh, okay. Megan Argerbright just confirmed they did not. So yeah, so we had none. We had one that just almost did, and they pumped the brakes on that. So